China's economy is recovering. Hello, it's great to have you tuning in to N.D.P News, the top channel for unbiased and impartial news. We don't just keep you up to date with the latest global events, but we also dive deep into the realm of geopolitics. We're grateful for your support as we come up on 500 subscribers, and we look forward to continuing to grow alongside our esteemed viewers. Now, let's take a closer look at China's economic recovery in today's analysis. The Chinese economy is showing signs of recovery, with consumers beginning to spend again, despite a cautious approach towards big-ticket purchases such as cars and apartments. The country's manufacturing industry is strengthening, although many factories are still operating below capacity. In addition, investments in infrastructure and manufacturing continue to be robust, even as new housing construction slows down. This recovery comes after the Chinese government lifted zero-COVID measures that had previously choked economic growth. As a result, the economy expanded by 4.5% from January to March 2023, driven largely by strong consumer spending. The recovery of China's economy is significant for the rest of the world, given that China has been a major driver of global growth for the past 2 decades. While tensions with the United States and Europe persist, China remains highly interdependent with both economies at a time of unease. The International Monetary Fund has warned of a potential slowdown this year, as central banks in the West raise interest rates and banks face challenges. To counteract any potential slowdown, China has taken measures to stimulate growth, including investing in high-speed rail lines, highways, and bridges, which create jobs and improve transportation infrastructure. The People's Bank of China has also allowed commercial banks to hold slightly smaller reserves against possible losses, which frees up more money for lending. Economists such as Louis Liu from Oxford Economics have expressed optimism for China's economic rebound and anticipate continued government support for weaker segments of the economy. The global stock and bond market, a tumultuous decline in 2023. The current year has witnessed a tumultuous decline in the global stock and bond markets, leaving investors grappling with an unpredictable future. The Treasury market has been particularly volatile, with unprecedented fluctuations potentially signaling an impending recession. A recent study highlights a shift in the stock market, with 8 tech giants shedding their pure growth label, while Exxon and Chevron maintain their status as value stocks. This shift bears significant implications for investors. Younger investors seeking to navigate the market volatility and secure their retirement are discovering that digital investment platforms lack the personal touch required to make informed decisions. Despite favorable conditions for stock pickers in 2022, most actively managed stock mutual funds underperformed the market. Unfortunately, this trend appears set to continue into the current year. China's economy has rebounded considerably in the first few months of the year, showing significant improvement from the final quarter of the previous year. However, the nation is not without challenges, with widening gaps in government budgets due to lagging revenue and increased spending. Additionally, the sluggish housing market continues to drag down the economy, with construction of new properties contracting by 5.8% in the first quarter compared to the previous year. Suzhou, a city situated along the Yangtze River near Shanghai, reflects the national trends with varying differences across different neighborhoods and businesses. While consumers and companies continue to spend, the economic climate is far from uniform. Service industries like travel and dining have shown the strongest growth, with hotels in Beijing and Shanghai experiencing long lines of customers, a far cry from the empty lobbies of last year. China's consumer spending has picked up, but unevenly. At the bustling street markets of Suzhou, 2 vendors stand in stark contrast amidst the unfolding narrative of China's uneven economic recovery. For Jiang Yongming, a butcher, the neighborhood's residents continue to exhibit frugality despite his display of succulent slabs of pork. He grapples with the challenge of customers asking him to chop large fillets into smaller pieces, only to end up purchasing a single fragment. In contrast, Liu Zhongyu, a catfish and clams vendor, speaks of a different experience. The pandemic had forced him to halt sales for a month last year when local restaurants shut down. But as restrictions lift, the same eateries are now placing significant orders. This microcosm of small businesses at the street markets paints a broader picture of China's economic recovery that is steadily gaining momentum, but remains far from equitable. While retail sales posted a meager 3.5% growth in January and February compared to the same period last year, March showed a significant uptick, signaling a robust recovery. However, this jump comes from an actual decline in March 2022, when the country grappled with rising COVID cases, leading to Shanghai's 2-month lockdown. Although some sectors are still reeling from the pandemic, China's economy is showing little signs of inflation. The country has refrained from sending pandemic checks and coupons to households, unlike the West, which has limited people's ability to bid up prices for goods. Consumer prices were only 0.7% higher in March compared to last year, and producer prices for industrial goods continue to decline. Despite the economic revival, millions of Chinese are still struggling to recover from the pandemic's financial fallout. Unemployment among 16 to 24-year-olds increased to 19.6% in March from 18.1% in February, while the incomes of millions remain severely depressed. While unemployment among residents aged 25 to 59 has declined from 4.8% to 4.3%. The foundation for economic recovery remains fragile. Inadequate domestic demand remains prominent, cautions Fu Lingwei, an official at the Statistics Bureau. Now, if you liked the video so far and haven't already, please subscribe and give this video a thumbs up. Are factories catching up on orders? Along one of Suzhou's canals lies a humble workshop dedicated to the repair of tabletop electric motors. Its proprietor, Guo, supplies the numerous small-scale workshops that craft nails and screws for the city's titanic industrial enterprises. While some of the surrounding businesses floundered amidst the pandemic, Mr. Guo attests that the survivors have emerged stronger than ever. Comparatively speaking, the situation now is far more favorable than before, and those that have not succumbed to closure have made significant strides towards recovery, he states. In March, industrial production, encompassing the production output of factories, mines, and power plants, witnessed a commendable growth of 3.9% from the preceding year, an improvement from the lackluster 2.4% growth experienced during the months of January and February. However, industrial expansion still pales in comparison to China's usual robust standards, with the slumping automotive industry serving as one of the primary impediments. The first quarter saw a 13.4% plunge in car sales. In a bold move at the end of last year, China terminated subsidies for electric vehicles and reinstated the sales tax on gasoline-powered cars, which had been in suspension. Despite this, exports have shown signs of recuperation, surging by a staggering 14.8% in March. The factories, grappling with an inundation of pending orders due to the zero-COVID lockdowns, are gradually but steadily making progress in reducing the backlog. China is building rail lines, not apartments. Investment in apartment buildings, roads and factories, and other so-called fixed assets has long been a mainstay of the Chinese economy. Fixed asset investment is growing, 5.1% in the first quarter compared with last year. But investment is not following a pattern welcomed by Beijing. Government spending on new rail lines, roads, and other infrastructure rose 8.8% in the first quarter compared with last year. Manufacturing investment was up 7%. Few sectors illustrate the challenges still facing China more than real estate. The Chinese housing market is experiencing a tumultuous period, with a cash deficit and a default on numerous foreign bonds. Housing developers are showing reluctance towards initiating fresh projects, despite a potential stabilization in prices. However, this has failed to assuage the skepticism of stock market investors, as evidenced by Sunac China Holdings' plummeting share price of 59% upon resuming trading after a year-long suspension. Even those who have recently acquired new residences appear hesitant to invest in the adornment and furnishing of their homes. For instance, a paint store located near Mr. Guo's electric repair shop reported a dwindling customer base, with the store owner Miss Lu lamenting the absence of business. If you enjoyed the video, make sure to check out our other videos on the channel for more great content. Also, take a moment to subscribe to the channel and hit the notification bell so you don't miss any future uploads. Thanks for watching. This has been N.D.P News, signing off.